Assalamualaikum warahmatullahi wabarakatuh. Today we are going to continue our lecture with methods to record revaluation. Basically, there are two methods of recording revaluation. Under the first method, adjustment of both gross carrying amount and the accumulated depreciation so that the adjusted net carrying amount is equal to net revalued amount. This is normal for plant and equipment. Second method, that is the most common method. The accumulated depreciation is eliminated at the valuation date so that net revalued amount is treated as the new gross carrying amount, and this is normally for land and building. But the most common method is method 2. So under the method 2, the journal entry will be number 1, to eliminate the accumulated depreciation by debiting accumulated depreciation and crediting asset account. And secondly, we recognize the surplus or deficit on revaluation. If it is a surplus, we have to debit asset account and credit asset revaluation reserve. And if the revaluation is deficit, we have to debit statement of profit or loss and credit asset account. So for this one, we are going to refer to illustration in example 10. Okay, but before that, let's look at the rules. Any gain or surplus arising from the revaluation is recognized as other comprehensive income and credited to revaluation reserve, which will be presented in the statement of changes in equity. Secondly, the revaluation reserve is regarded as a non-distributable reserve. So any deficit arising from revaluation is charged to profit or loss. A deficit arising from the revaluation of an asset cannot be offset against a surplus arising from revaluation of another asset. Okay, let's look at this example, example 10. On 1st May 2008, PQR Sendirian Berhad carries in its books a manufacturing plant at a cost of 500 million and accumulated depreciation of 100 million. The plant is constructed 2 years ago and has been depreciated on the straight line method over 10 years. On that date, the plant is revalued upward because current prices have increased substantially. The basis of the revaluation is the depreciated replacement cost, and the relevant data are as follows. Replacement cost of the same or equivalent new plant is 800 million, less accumulated depreciation for 2 years, that is 800 million divided by 10 times 2 years equals to 160 million, and the depreciated replacement cost is 640 million. So the revalued amount is 640 million. We're required to A, calculate the gain or surplus arising on the revaluation and show the journal entry under each of the method 1 and method 2 of recording revaluation of asset. And secondly, B, present the plant account after the revaluation under each of the two methods. Okay, let's go through the calculation of revaluation surplus. Revaluation surplus is equal to net revalued amount, that is 640 million, minus net book value or the old carrying amount. So 640 million minus 400 million is equal to 240 million. So there is a surplus on revaluation of 240 million. Under the first method, what we are going to do, we are going to debit plant account 300 million. And then we are going to credit accumulated depreciation 60 million. And we are going to credit other comprehensive income for revaluation reserve of 240 million. This is the first method. Under the second method, we are going to debit accumulated depreciation And we are going to debit accumulated depreciation, because this one we eliminate the accumulated depreciation that we have provided 100 million, and we debit plant account 140 million, decrease in plant, in carrying amount of plant is 140 million, and credit other comprehensive income revaluation reserve 240 million. If we separate the journal entry, what we can do is debit accumulated depreciation, credit plant 100 million, and debit plant and credit revaluation reserve 240 million. Note that irrespective of the method used, the gain or surplus arising on revaluation shall be recognized in other comprehensive income and credited to revaluation reserve. IFRS 116 prohibits crediting to income the accumulated depreciation existing at the date of revaluation. The question B is about the presentation of plan. Under method 1, the plan will be presented at plan at valuation 800 million less accumulated depreciation 160 million. So the net carrying amount is 640 million. So under the first method, we are going to show the calculation, that is the plan at valuation is 800 million minus accumulated depreciation of 160 million, and the carrying amount on the date of revaluation is 640 million. However, for method 2, we are going to show plan at valuation 640 million. Only one figure will be shown. Next is example 11. In example 11, we have an example here. TKO Berhad owns 2 pieces of freehold land in Selangor. Land A is purchased in 2000X1 at the cost of 10 million, while land B is purchased on 2000X2 at the cost of 12 million. The land are classified as property, plant, and equipment under IFRS 116. The land are revalued as follows. So there are 3 revaluations of altogether for each plant or for each land. So the land A was revalued to 8 million in 2000X3, 12 million 2000X5, and 11 million 2000X7, whereas land B was revalued to 16 million in 2000X3, 11 million in 2000X5, and 20 in 20X7, it was revalued to 14 million. So what we are required to do, A, at each valuation date, calculate the surplus or deficit arising on revaluation of both land A and B. And then B, determine the balances in the land and revaluation reserve account respectively at the end of each year. And C, show the journal entry to record the revaluation at each valuation date. So the first one, we need to calculate the surplus or deficit on revaluation of land A and land B. So the balance brought down on 1st January X3 for land A is 10 million. And then there is a revaluation surplus at the end of year 2000 X3 of, revaluation deficit of 2 million. So the balance is 8 million. 8 million. The balance at the end of 2000 X3, 8 million, yeah. And then revaluation happened again in 2000 X5. So at that time, there is a revaluation surplus of 4 million. And the balance at the end of 20X5 is 12 million. And lastly, there is a revaluation deficit. Revaluation deficit in 2000X7 of 1 million. Because the land was revalued to 11 million. So we can see from here the movement in land. Land A. What about land B? The movement of land B, it starts with the balance brought down on 1st January 2003 of 12 million. And then it was revalued to 16 million. So there is a surplus of 4 million. Then it was revalued further to 11 million. So there is a deficit of 5 million. And lastly, in 2007, it was revalued to 14 million. So there is a surplus again of 3 million. So at the end of 2007, the balance, the carrying amount of land A is 11 million and the carrying amount of land B is 14 million. And this is the balance in the revaluation reserve account for A and B. Okay, let's look at the movement. So in 2000X3, in January, since the first revaluation happened on 31st December 2000X3, so there is no revaluation surplus for land A because it is a revaluation deficit. So the balance of revaluation reserve of land A at the end of 2000X3 is 0. And then the second revaluation happened in 2000X5. In 2000X5, whereby there is a revaluation surplus. Yeah, there is a revaluation surplus of 2. Yeah, there is a revaluation surplus of 2 million. So the balance at the end of 20X5 is 2 million. And then there is a revaluation deficit in 2007 of 1 million. So the balance at the end of 20X7 is 1 million. What about land B? The revaluation reserve of land B, it starts with revaluation, the first revaluation in 2000X3, whereby there is an increase. There is an increase by 4 million. Land B increased by 4 million. So there is a revaluation surplus balance of 4 million at the end of 2000X3. And then in 2000X5, there is a revaluation deficit of 5 million. However, since the balance of revaluation is only 4 million, okay, what the company can do is the company can reverse only 4 million. So the balance of revaluation reserve at the end of year 2000X5 becomes 0 until there is the last revaluation in 20X7 when the value of land increased by 2 million. So it goes back to a positive figure that is at the end of 2000X7, the balance of revaluation reserve of B is 2 million. So land million, 1 million, 1 million for land A, 1 million for land A, and 2 million for land B at the end of 2000X7. What about the journal entry? In 2000X3, for land A, we are going to debit profit or loss 2 million. 2 million because of deficit of 2 million and credit land A account 2 million. For land B, debit land B account 4 million and credit other comprehensive income for revaluation surplus of 4 million. Plus 4 million revaluation surplus. In 2000X5, debit land A. Debit land A 4 million. Okay, and then credit profit or loss. Credit profit or loss 2 million and credit other comprehensive income of 2 million. Okay, why we have to credit the profit or loss 2 million and credit revaluation reserve 2 million? Because the first revaluation of land A, the result is a deficit. So now we are reversing the deficit that we have debited in our SOPL, yeah, in the year 2000X3, because now in 2000X5, the revaluation is revaluation surplus of 4 million. So we can reverse 2 million only, and the balance of 2 million will be credited to revaluation reserve of A. What about B? In B, we are going to debit other comprehensive income, revaluation reserve of 4 million, because at this time, there is a revaluation deficit of 5 million. The first revaluation is revaluation surplus of 4 million. So now we can reverse the 4 million from the revaluation reserve and leaving 1 million that cannot be reversed. So 1 million will be, 1 million is debited to profit or loss account. And land B was credited with 5 million because revaluation deficit of 5 million. And then in 2007, we are going to debit revaluation reserve of A, 1 million, and credit land, 1 million. Okay, because there is a revaluation deficit. Yeah, there is a revaluation deficit in A. And for B, debit land B, 3 million, credit profit or loss, 1 million, and credit other comprehensive income revaluation reserve, 2 million. So by doing this journal entry, we can see that the balance of asset revaluation reserve in A is 1 million and asset revaluation reserve in B is 2 million. Okay, the next subtopic is about depreciation accounting. As the benefits to be derived from the use of property, plant, equipment stretch over several accounting periods, the initially recorded cost of the property, plant, equipment shall be allocated fairly over those periods by depreciation charges. What is depreciation? Depreciation is an allocation of the depreciable amount of property, plant, equipment over its estimated useful life. This is according to paragraph 6 of MFRS 116, whereby depreciable amount is equal to cost less residual value. It is a measure of the consumption, the wear and tear, and or decline in value due to technological obsolescence or passage of time, as the property, plant, equipment is used up in the operations or in ordinary course of the business of the entity. Depreciable amount. Yeah? Depreciable account or depreciation accounting actually. Depreciation accounting applies only to depreciable asset. Yeah? Depreciation accounting only applies to depreciable asset. Depreciable asset are assets which are used beyond one accounting period, have limited useful life, and used in the production or supply of goods and services, rented to others, or used for administrative purpose. For example, freehold land is not a depreciable asset. It is a property, plant, equipment, but not a depreciable asset because it has unlimited or infinite useful life. Thus, it is not subjected to depreciation accounting. The building on the freehold land which have been acquired together with the freehold land is a depreciable asset and subject to depreciation accounting since it meets the definition of a depreciable asset. According to paragraph 43, each part of an item of property, plant, equipment with a cost that is significant in relation to the total cost of the item shall be depreciated separately. According to paragraph 44, initially a business recognized the property, plant, equipment according to its significant parts. Thus, depreciation is also calculated separately according to the allocated parts. For example, separate depreciation is calculated for each of the building structure, lift and elevators, and electrical equipment. According to paragraph 48 and 49, the depreciation charge for each period shall be recognized in profit or loss as depreciation expense, unless it is included in the carrying amount of another asset. Product costing of inventories under MFRS 102 or in the cost of product development under MFRS 138. There are three determinants of depreciation charge. The first one is the depreciable amount. The second point is estimated useful life. And the third point is depreciation method. We go to the first one, depreciable amount. Depreciable amount is the cost or revalued amount minus estimated residual value. What is estimated residual value? It is actually an estimation of amount that an entity would currently obtain from the disposal of the asset. That is the amount that the entity could currently obtain from the disposal of the asset. And we have to minus the estimated cost of disposing the asset. Second determinant is estimated useful life. What is estimated useful life? It is actually the time period. For example, number of years over which an asset is expected to be available for use. Or it can also be based on number of production or similar units expected to be obtained from the asset. Estimation is a matter of judgment and shall normally be based on experience with similar type of assets. The third determinant is depreciation method. It can be straight line method. It can be accelerated depreciation method, also known as diminishing balance or reducing balance method, or number three, sum of digit method, or number four, units of production method. The basis for computation of depreciation, it can be based on monthly, it can be based on yearly. For monthly, it is time apportioned depreciation expenses, and for yearly basis, depreciation was charged full year in the year of purchase and none in the year of disposal. What is estimated residual value? The residual value is the estimated amount that company would currently obtain by disposing of the asset, less any disposal cost, assuming that the asset is of the expected age and condition at the end of its useful life. The residual value is the estimated amount that can be expected by the company to be received for an asset at the end of its service life, less any anticipated disposal cost. It is the amount the company can acquire when they dispose an asset at the end of its useful life. It is common to disregard the estimated residual value. We assume that residual value is zero unless the residual value is significant. Residual value shall be estimated at the date of the acquisition or the date for similar assets which have reached at the end of their useful lives and have operated under conditions similar to those assets will be used. At acquisition date, an estimation of an aeroplane residual value, aeroplane residual value at the end of useful life is made using similar model of airplane that have reached the estimated useful life and have operated under similar conditions. What is the difference between residual value, salvage value, and scrap value? Basically, they are the same. Sometimes we use the term residual value, sometimes we use the term salvage value, and sometimes we use the term scrap value because they are referring to the same thing. This estimated amount is used in the calculation of an asset, depreciation, expense, and often the amount is assumed to be zero. Factors affecting the estimated useful life. Number one is physical factor. Number two is technological factor. Number three is economic factor. And number four is legal factor. Okay, what is physical factor? Physical factor is related to wear and tear, which may reduce the performance capability of the asset. Technological factor, which may render the asset obsolete in terms of the goods it can produce or service it can provide. And it is also related to advancement of new technology. What about economic factors? Economic factors which may cause the product produced by an asset to be uncompetitive in the marketplace because of changes in market perception and demand about the product. And lastly, legal factor which limit the useful life of the asset. Limit the useful life of the asset. Sometimes the economic life is still there. It is still economical to have that asset, but the useful life of the asset with the company is limited because of legal factors. Because normally, there will be a fixed number of years. Fixed number of years. Let's say 5 years, 7 years, even though the life of the asset can be 10 years. Okay. Estimated useful life based on a business asset management policy is not synonymous with economic life based on manufacturer's specifications. The property, plant, equipment may be estimated to have a residual value at the end of the useful life. If a property, plant, equipment estimated useful life that is equal to its economic life, then the residual value is estimated to be zero. If economic life may not equal to physical life of a property, plant, equipment. So economic life may not equal to physical life of property, plant, equipment. Sometimes economic life is longer than, sometimes the economic life is longer than physical life. Sometimes the physical life is longer than the economic life of the property, plant, equipment. The usage or consumption differs among property, plant, equipment items. Some are used evenly or over their useful life. Yeah, evenly. They are used evenly. What did mean? What is the meaning of evenly? The company will charge the same amount of depreciation over their useful life. Others have greater or heavier usage during the early years, and some are used according to the production level. According to paragraph 50 of the standard, the depreciable amount of an asset shall be allocated on a systematic basis over its useful life. As such, the depreciation method adopted shall reflect the pattern in which future economic benefits are expected to be consumed by the business. That is, the depreciation method should reflect the pattern of consumption of the asset. MFRS 116 established consumption of the economic benefit as the underlying principle for recognizing depreciation or amortization. The amendment to the standard clarifies that when applying the standard, a revenue-based method of depreciation should not be used to calculate the depreciation because that method reflects a pattern of economic benefit generated from the asset rather than the expected pattern of consumption of future economic benefit. Okay, we have one illustration here. That is example 13. But before that, let's look at the method of depreciation. We have four methods here. The first one is straight line method. The second one is diminishing return. The third one is sum of digit. And the fourth one is units of production. So we go to the first one. In the straight line method, the cost was allocated evenly. Yeah, the cost of the property, plant, equipment was allocated evenly throughout the accounting period during its useful life. And the advantage of this method is it is simple to apply. Simple to apply. And the disadvantage is disproportionate matching of costs. Its benefits over several periods. What about the second one? Diminishing return, also known as reducing balance method, RBM. Depreciation amount is allocated more than to the earlier years of the property, plant, equipment useful life. And this method is actually more matching to the cost benefit analysis. The third method is sum of digit. The depreciable amount is allocated more to the earlier years of a property, plant, equipment useful life. And this is more matching to the cost benefit analysis. And the last one is units of production. The cost was allocated based on the actual units produced in each period in relation to the estimated total production units. The advantage of this is it reflects more accurately the actual usage. However, it has disadvantage also that is difficult to apply in practice due to subjectivity in estimating the total production units. So it is not easy to estimate the actual total production unit. Example 13. An equipment with the cost of 110,000 is expected to have a useful life of 5 years. The estimated residual value is 10,000. Required, calculate the depreciation to be allocated in each year in the 5-year period under the straight line method, the reducing balance method, and the sum of digit method. Okay, we go through one by one. We take the straight line method first. So using the straight line method, the depreciable amount is 110,000 cost minus 10,000 residual value. So depreciable amount is 100,000 and 100,000 will be divided by 5 years. So in each year, the company will charge 20,000 as depreciation. So this is under the straight line method. What about the second method, that is diminishing balance? Under the diminishing balance, the percentage that is used by the company is 38.1% per annum. Yeah, 38.1% per annum. So we have to calculate the depreciation for each year from year 1 until year 5 using this 38.1%. So under the diminishing balance method, there is no residual value. So depreciation is calculated based on the ending balance. So it starts with opening balance, that is 110,000 times 38.1%. So depreciation for the first year is 41,910. And then for the second year, 110,000 will be deducted with the first year depreciation, that is 41,910. So the depreciation of 38.1% will be multiplied with this balance, ending balance of year 1. And we get 25,942. And the rest of year 3, year 4, and year 5, the depreciation is calculated based on the balance and based on the reducing balance of the asset, until at the end of the year the depreciation charge is, okay, the last year, the 5th year, 6,150. 6,150. And the third method is sum of digit. So sum of digit is referring to a situation where we are going to add the number of years to become a sum of digit. So if the depreciation will be charged over 5 years, 1 will be added. 1 plus 2 plus 3 plus 4 plus 5. So 1 plus 2 plus 3 plus 4 plus 5 equal to 15. That is the total sum of digit. So in the first year, we are going to take 5 digits. In the second year, 4 digits. In the third year, 3 digits. In the fourth year, 2 digits. And in the fifth year, 1 digit out of 15 digits. So in year 1, the total depreciation is, we take the depreciable amount, 100,000. 100,000 times 5 over 15. So it equals to 33,333. Okay, and then in the second year, 4 over 15 times 100,000. In the third year, 3 over 15. In the fourth year, 2 over 15. And in the fifth year, 1 over 15. So at the end, the total depreciation is 100,000. Okay, this is an example of computation of a reducing balance method. A reducing balance method, for those who have the book, you can refer to page 420. An asset has a useful life of 3 years, and the cost of the asset is 2,000. The residual value is 500. Depreciation charge is 50% on the carrying value. Prepare a schedule showing depreciation charge, accumulated depreciation, and carrying value for 3 years. So we have 3 columns. The first one is depreciation charge. The second one is accumulated depreciation. And the third one will be the carrying value. In the first year, how to calculate the depreciation in the first year? So in the first year, since there is a residual value of 500, 2,000 minus 500 equal to 1,500. That is the depreciable amount times 50%. So the first year depreciation is 750. Accumulated depreciation is 750. And the carrying value is 2,000 minus 750. That is equal to 1,250. Okay. So depreciation for year 2 Depreciation for year 2 is equals to 1,250 minus 500 residual value times 50% equals to 375. And accumulated depreciation is 750 plus 375 equals to 1,135. What is the carrying value? The carrying value will be 2,000 minus 1,125 equals to 875. And in the year 3, what is the value of depreciation? The value of depreciation is 875 minus 500, so it equals to 375. Accumulated depreciation is 750 plus 375 plus 375, so equal to 1,500. And the carrying value is 2,000 minus 1,500 equals to the residual value of 500. Depreciation for the last year of the useful life, that is the carrying value, at the start of the period less estimated residual value. This is to ensure that depreciation is charged in full. Note, if rate of depreciation for RBM is not given and the asset has residual value, use formula to calculate the rate of depreciation. Residual value already considered in the computation of rate. Hence, to compute depreciation charge, use cost as depreciable amount. If policy give rate of depreciation and asset have residual value, assume that rate given has not considered any residual value. Therefore, to compute depreciation charge, the depreciable amount is equal to cost or carrying value minus residual value times the rate of depreciation. And second last point or second last subtopic for this big topic, property, plant, equipment. Okay, for this one we can refer to page 431 for those who have the book. It is concerned with when an item of property, plant, equipment ceases to be recognized in statement of financial position. According to paragraph 67, the carrying amount of an item of property, plant, equipment shall be derecognized on disposal. On disposal means, on the date where we dispose the asset, and B, when no future economic benefit are expected from its use or disposal. So what we have to do? We have to remove. We have to remove both the gross carrying amount, that is the cost or the cost or revalued amount, and the accumulated depreciation of the item from the entity's accounting record. That is, fully depreciated property, plant, equipment which continues to be in use shall be retained in the accounts, whereby the items of property, plant, equipment which are temporarily retired from an active use or abandoned will be retained in the account. This property, plant, equipment may be subject to impairment. And secondly, write-off property, plant, equipment. No future benefit expected from the property, plant, equipment, so remove from the company's book. Any remaining carrying amount at the date of derecognition will be recognized as an expense in the statement of profit or loss. On derecognition, recognize the resulting gain or loss. According to paragraph 68, the gain or loss arising from the derecognition of an item of property, plant, equipment shall be included in the profit or loss when the item is derecognized, unless on a sale and leaseback, according to MFRS 117. Gains shall not be classified as revenue, but classified as other income. Disposal by sale, gain or loss, is the difference between the net disposal proceeds and the net carrying value of the disposed asset. So we are comparing the disposal proceeds and the carrying amount of the asset. So if the disposal proceed is greater, it is a gain. If the carrying amount is greater, it is a loss. Disposal of significant item under MFRS 15. MFRS 15, revenue apply to determine date of disposal. the date of control. Date of disposal is the date of control of the property, plant, equipment is transferred to the buyer. What is the meaning of transfer of control? We transfer the risk and reward of the property, plant, equipment to the buyer. Disposal of a previously revalued property, plant, equipment. Sometimes we have revalued our property, plant, equipment, and subsequently we dispose the property, plant, equipment. So we may have a balance of asset revaluation reserve. So what we are going to do, first, gain or loss, that is the difference between the net disposal proceed and net carrying amount at disposal date. Any remaining revaluation. So for the first one just now, gain or loss. Gain or loss will be transferred to statement of profit or loss. Any remaining revaluation reserve shall be transferred directly to retained earning, not to profit or loss, to retained earning in the statement of changes in equity, because now the revaluation reserve become a realized earning. So as a result of transfer of asset revaluation reserve to retained earning, okay, actually it is a direct transfer from a non-distributable reserve to a distributable reserve. Asset revaluation reserve cannot be distributed, but retained earning can be distributed. Example, a motor vehicle with a cost of 150,000 and accumulated depreciation of 110,000 is sold for 50,000. In this case, the gain on disposal is 50,000 minus 40,000. The carrying amount is 40,000. That is 150 minus 110. So there is a difference of 10,000. The 10,000 is gain on disposal. The journal entry will be passed. Number one, to eliminate the accumulated depreciation, if any, and secondly, to eliminate the motor vehicle, and thirdly, to recognize any gain or loss on disposal. So from here, we know that the sales proceed is 50,000. So debit cash 50,000, debit accumulated depreciation 110,000, credit motor vehicle 150,000, and debit gain on disposal of 10,000. Okay. Our last subtopic under property, plant, equipment is disclosure of property, plant, equipment. Each item of property, plant, equipment shall be recognized separately in a property, plant, equipment register. According to paragraph 73, for presentation in the financial statement, the property, plant, equipment are aggregated and presented by classes. That is, a grouping of assets of similar nature or similar use in reporting entities operation. So we have example of separate classes. For example, land, or land and building, or machinery, or motor vehicle. According to the same paragraph, the financial statement shall disclose for each class of the property, plant, equipment. Number one, the measurement basis used for determining the gross carrying amount. Secondly, depreciation method used. Thirdly, the useful lives or the depreciation rate used. Number four, the gross carrying amount and the accumulated depreciation at the beginning and at the end of the period. And number five, reconciliation of the carrying amount at the beginning and at the end of the period, showing, among other, addition and also depreciation. The financial statement shall also disclose, among other, the existence and amount of restriction on title and property, plant, equipment pledged as a security for liabilities, the amount of expenditure recognized in the carrying amount of an item of property, plant, equipment in the course of its construction, the amount of contractual commitments for the acquisition of property, plant, equipment. Property, plant, equipment stated at revalued amounts, among other, the following shall be disclosed. Number one, the effective date of revaluation. Number two, where an independent valuer was involved. And number three, methods and significant assumptions applied in estimating the item's fair values. And number three, the standard also encourage voluntary disclosure of carrying amount at temporary idle of temporary idle property plant equipment, the gross carrying amount of fully depreciated property plant equipment, the carrying amount of property plant equipment retired from active use and not classified as held for sale under MFRS 5. And number 4, when the cost basis is used for the fair value of property plant equipment when this is materially different from the carrying amount. So this is the example that we can find at the back of the financial statement under the notes of financial statement. So under the notes of financial statement on property plant equipment, we can see this at least a few columns based on classes of non-current asset. The example here is freehold land, building, motor vehicle, and others. And don't forget that the last column will be column for total. And this table comprises of 3 layers. The first layer is about the cost, opening balance of the cost until the closing balance of the cost. And then opening balance of the accumulated depreciation until the closing balance of the accumulated depreciation. And lastly, the difference between the closing balance of cost and the closing balance of accumulated depreciation. That is the carrying amount of the respective classes of assets. So freehold land, what is the carrying amount? Building, what is the carrying amount? Motor vehicle, what is the carrying amount? And lastly, the total carrying amount for all the non-current assets. All the non-current assets. So we can see from here that the movement of cost can be because of purchases, can be because of disposal, can be because of elimination of depreciation, can be because of revaluation. For accumulated depreciation, the movement in accumulated depreciation is because of depreciation for the year, elimination of depreciation, as well as disposal. Okay. So that is all for our topic on property plant equipment. Next class, we are going to discuss about tutorial question. So we can end our class today. Assalamualaikum warahmatullahi wabarakatuh.